You probably want exceptional investment returns with minimum effort. Here's the man who says that his strategy can. Today we have with us Tobias Carlisle. He's the man behind this investment strategy known as the Acquirer's Multiple. He's the fund manager of Carbon Beach Management, and he has also authored a series of best-selling books, including the latest book, The Acquirer's Multiple. So Tobias, can you explain to our audience what this Acquirer's Multiple is all about?
Sure. So many people are familiar with Warren Buffett. He's perhaps the most famous value investor of the last few generations. In 2006, Joel Greenblatt wrote a book called The Little Book That Beats the Market, and he described an investment strategy in that called the Magic Formula. And the Magic Formula is this simple quantitative application of Warren Buffett's investment strategy. And basically the idea is that Warren Buffett says that he looks for wonderful companies at fair prices. And what he means by that is very profitable companies, very high returns on invested capital. And fair prices means fair prices based on an operating earnings to enterprise value ratio. So Greenblatt wrote the book. He talks about how that metric works. I read it, and I had been trying to apply Buffett's investment methodology without much success. I just sort of found that the stocks that I bought, the profitability was sort of would disappear after I bought the stocks, and they wouldn't perform as well as Warren Buffett did. And it was just something in my mind that I wanted to test it and see whether you were buying these stocks right at the very top of their business cycle, and you were sort of they were cheap for a good reason. So I got an opportunity to test it in 2012. I partnered with a PhD student from the Booth School of Business, which is probably the best quantitative business school in the States. And we tested the Magic Formula, and we found even if you apply really rigorous testing rules that you do in academia, you make it by very large companies that are very liquid, and you do various other things to make sure that there's enough stock to actually invest into it, you find that it does in fact beat the market, and pretty comprehensively. So the Magic Formula is a good strategy. But then when you break down the returns to it, what you find is that the return on invested capital actually drags the return down, and the return on invested capital by itself would underperform the market. But the value factor, the operating income on enterprise value factor, generates all of the returns and more. So just getting rid of the quality factor leads to even better returns. So that value factor by itself is what I call the acquirer's multiple.
Thank you for your explanation. I've actually read something along the line that you have just mentioned about Warren Buffett. You are saying that his strategy is very difficult to quantify, and he somehow has this knack of identifying investments with moats such that their long-term return on equity doesn't really get eroded. But it's very tough for the individual investor to do it, right?
Well, investor strategist Michael Mauboussin has looked at that question and said, what are the properties that would lead a company to maintain profitability over a 10-year period? So he's been doing this for quite a while now, and he looks at these rolling 10-year periods. And so he goes back to 2008. So for this year, he'll look at the 2008 companies, and then he uses a DuPont analysis to sort of break them down and see whether it's capital being turned over or profit margin or what it is that's driving the returns. So basically, he's been unable to find any scientific method of identifying which stocks will outperform over the following 10 years. All that he's able to say is that we do find at the end of the 10 years that there is this very small proportion of stocks, it's about 4%, that do maintain their profitability over the full period. So the question is, are you able to identify that 4%? And it turns out that it's basically random chance. You're flipping a coin if you're working out whether it's any given stock that's going to do that. So all I'm saying in my method is that if you ignore the return on invested capital, which might indicate a moat or it might indicate a company at the top of its business cycle, what you tend to find is that just removing that error leads to better returns. So over a portfolio of 20 to 30 or more stocks, those stocks as a group, if you buy them cheaply enough, will beat the market and they'll beat the magic formula.
So in other words, you're saying that it's easier for an individual investor to do value because he can quantify it and he probably do a lot better with it.
Exactly right. And in addition to that, we've looked at some of the criteria that indicate. So there are things that do lead to better performance, and so those things are the things that you would expect. You don't want to buy fraud. You don't want to buy earnings manipulation, which might be the first step down the road to fraud, and you want to avoid companies in financial distress. And so there are statistical methods for finding those things, and you often find them all together. There's no reason for a company that's not in financial distress to do any earnings manipulation. If they're already very profitable, they don't need to do that. And fraud is sort of the end of that road where they're trying to hide. And it's often not in the bull market when we find the fraud. It's in after the collapse. They go back and look at some of these companies and they say, oh, they didn't actually make all that money that they said they were making at the time. So all of these methods are trying to do is to avoid companies. And the sort of things that it identifies as WorldCom, Enron, famous frauds. And a lot of these companies that as a fundamental investor, if you look at their financial statements, you see problems with them. And the things that you see are they're not making the cash flow doesn't match the accounting earnings, because accounting earnings can be manipulated in various ways. So can the cash flow, but ultimately the cash flow has to show up somewhere. It has to show up in a bank account, it has to show up as an asset somewhere. And to the extent that it doesn't do that, you want to avoid those companies. So the sort of companies that I like to buy, they're cheap. They're not particularly great businesses at the time that they're being bought, but they're generating lots of cash flow. They've got cash in the bank. That means they can survive and get to another period of time where conditions might be better and they can make more money. So that's the sort of thing that I'm trying to do. Buy them really cheap at the bottom of their business cycle and then hold on through the really bad period the next 2 or 3 years. And that's a power that value investors have that investors who are much more focused on the short term don't have, that if you can think out 1 year, 2 years, 3 years and not worry about what happens to it in between, then you often find that the problem goes away and they look much healthier, at which time they become the sort of companies that value that the franchise guys want to buy, and that they're the companies that we want to sell to them.
I've read your foreword in the latest book, The Aquarius Multiple, and you mentioned that it was targeted for beginners. I just wanted to ask if you think that this kind of quantitative deep value investing strategy is suitable for beginners.
I do, and the reason that I think that is it's very hard to learn all the intricacies of financial statements without having a lot of experience. You can be taught at university, or you can do a CFA or one of those sort of courses to understand financial statements, but it takes a long time to sort of really understand how they breathe and how they kind of live and how one industry varies from another industry. The nice thing about a quantitative method is a lot of that effort has already been done. The thing that hurts investors when they first start out is they don't understand that you can invest to not beat the market by buying a cheap index fund. That should be the first step as an investor. But if you want to beat the market, you should know that it's very, very hard to do. But the only way that you're going to be able to do it is by doing something different from the market. And so that means doing something different from the crowd. And that is going to mean buying, you don't buy the hot stock. You don't get to buy Tesla. You don't get to buy Netflix. You won't own Amazon. You won't own Bitcoin probably. You may have bought Bitcoin a long time ago, but you wouldn't buy it now. The sort of stuff that you're buying is something that nobody's ever heard of, or they think it's a disaster. Those are the kind of companies that you're buying, and the reason is that you're hoping that you're proven right, that they become popular companies, but later down the road.
You have mentioned that usually the famous companies would not appear in a deep value screen, and some people are just unable to buy those less familiar stocks. They somehow have a group of stocks they always wanted to buy, and probably they hope to see it in the screen. Do you see this as one of the major issues with a quantitative method?
It's a very well-known issue in the social sciences, and any anywhere where you're attempting to make a prediction based on sort of the incomplete information that you have in front of you on a future uncertain state. And it can be applied to sort of picking which vintages of wine will lead to the best bottles down the road, determining whether a criminal will be a recidivist or not when they're released back into a prisoner released back into society, when somebody presents at hospital if they're psychotic or just depressed. And so they've found that there are these simple statistical rules, simple algorithms, which is basically just a questionnaire, could be 5 or 6 questions in a row, and you yes or no, and it leads you down to the answer. They've found on sort of hundreds and hundreds of these surveys that they lead to better results than even experts can achieve. And the reason that they find that these things tend to work, I should say, first of all, they work if the expert is given access to the simple statistical model and allowed to answer the questions and get to the bottom and then make a decision whether to follow it or not. If they do that and they decide not to follow it, what they find is that they underperform the simple statistical model by itself. And the reason is this idea called the broken leg phenomenon. The idea is basically you've got some sort of, to explain the idea, you've got this model that tells you whether somebody will go to the cinema on a Friday night, and it might have in the model whether it's raining or not, the type of movie that's on, is it action or is it comedy or is it romance, and all of these other factors that might go into whether the person goes or not. And you learn one day that they have a broken leg. So that's not information that the model has considered. That's sort of outside the model. And so the question is, should you be allowed to then override the model by including that information in the model? And everybody says, well, of course you should, because now you know he's got a broken leg. That must affect your decision about whether he goes to the cinema or not. And the answer is you shouldn't. And the reason that you shouldn't override the model is that we find too many reasons to override the model. There are too many broken legs. That's particularly apt when you're looking at deep value companies, which is what I do. If you're looking at these companies, they've all got broken legs. So the broken leg is the reason why they're cheap. And so once you know that, you say, well, that's the reason why it's cheap. It's got a cash-rich balance sheet. It's generating free cash, so I can buy this company knowing that it's got what looks like a broken leg. And if that broken leg goes away or gets fixed, then this company should be trading much, much higher. And that's the reason that I like to apply a pretty quantitative approach to deep value investing.
That means you must be quite a Zen master to overcome some of your biases.
Or lazy.
Besides this problem, do you see any other issues? Or have you ever even gotten into any argument with readers who disagree with your points?
Well, of course, all the time. It's very confronting to hear that a model that is as simple as this one seems to do very, very well over long periods of time, seems to beat the market over long periods of time. And you have to remember, like 80% of professional money managers can't beat the market. So there's something confronting about learning that there is this very, very simple model. It's even simpler than the magic formula, which is a very, very simple model. The wrinkle to that is, though, that it does go through periods of underperformance. And when it's underperforming, it's this sort of metaphysical question, philosophical question, will this ever recover? Will this start working again? And I'm as shocked as anybody. I look at the portfolio all the time and I think this is crazy that we own some of this stuff. I mean, I know why retail in the States is beaten up, because Amazon is such a convenient way to shop. Why would you ever go to a mall ever again to go and buy something from the mall? But then if I look at those stocks individually, often they have a lot of cash on the balance sheet. They are generating lots of free cash flow, lots of operating income, and they're very, very cheap. And so all they really have to do is survive for another 12 months, and they should be much more valuable stocks. And that's what's happened over the last 12 months. A lot of these companies that you would have written off completely knowing the strength of Amazon, they've had a very good run over 12 months. And it happens every year. It's a different industry every year. Last year, I think it was airlines. and airlines had a very good run. So I was buying airlines before Buffett announced that he was buying airlines, and I felt like an idiot because he has written, and I've read what he's written for years and years about hating airlines, and yet here they all were. There were 6 or 7 of them at one time in the screen, and so I bought them. And then shortly thereafter, they announced that Buffett had bought them, and so I cheered that one. That was a good one.
Do you have any memorable rebuttals from anyone regarding your investing style?
Well, the argument is always, well, Buffett is a multi-billionaire, and he has described this investment strategy pretty comprehensively in his letters. And and if you read the letters, really what he's talking about all the time is how to find a moat. That's the thing that he spends the most time doing. But I don't think that, I'm not saying that what Buffett's doing, I think that what Buffett's doing is exactly right. And if I was a genius of Buffett's level, I would be doing that too. But unfortunately, I'm not. So I have to find something that, for my own sort of level of intellect and ability, that helps me invest. And so for me, it's the acquirer's multiple if you buy stuff cheaply enough. But here's the funny thing. So Apple came into my screen a few years ago, and once again, it was one of the cheapest 10% of large cap stocks. And it's happened a few times. It happened in 2013, happened in 2016, because people get concerned that the iPhone is getting boring, or there's other competition for the Apple TV or something like that. And it gets very, very cheap. And so I saw it in the screen again, and I tweeted out about it, told everybody about it. It was in the top 30 cheapest stocks in the States at the time, in the large cap sector. And Buffett bought it. So I think what Buffett bought it afterwards. I think what Buffett does is he's actually buying stuff really, really cheap, where it doesn't actually matter that much if the moat is there or not. But then he's also using 60, 70 years of investment experience to look at these things and say that's got a pretty good chance of surviving, maintaining its moat, and it's very, very cheap. So I don't think he's really paying up for a lot of these companies.
Since the acquirer's multiple is a quantitative method, you require a lot of financial data. And I see that you have developed the acquirersmultiple.com, a site where you deliver such financial data to individual investors. And I also noticed that they are mainly for US companies. How does acquirer's multiple work in other countries? Would it be the same principles, or do you foresee any other things that investors should take note of when they apply this strategy outside of US?
I have seen research on the application of the ratio to every developed market and every sort of large stock market in the world, and in every single market it generates it's very good at identifying the cheap stocks, it's very good at identifying the overvalued stocks, and it's very good at finding the spread between the two, which is sort of, as a quantitative investor, that's also what you're interested in, because you might be long and short. The bigger the spread between the cheap stocks and the expensive stocks, the better the return. So in every sort of developed market in Asia, in Europe, the US, the UK, Australia, New Zealand, the research seems to show that it is pretty good at finding undervalued stocks that if you buy them as a portfolio and you have enough time, they will tend to beat the market.
I hold the view that financial data outside US is of lower quality, and running a quantitative investment strategy, the quality of data becomes very important. Do you think this is one of the major issues that we would have when we invest in foreign countries?
I think for most countries have pretty good financial data. The issue is often in backtesting. How far back can you go with the financial data? That's the main problem. In terms of screening and finding companies today that are cheap, there are lots of good services that do that. They tend to be very expensive if you want all of them. So CapIQ or Bloomberg offer that data, but it's sort of $30,000 US a year. It's too expensive for most individual investors. So you can hand calculate these things. You can find the financial statements and calculate the operating earnings, calculate the enterprise value, work out whether it's sort of cheap or not. That's the challenge, is often tracking down the data. But in Singapore, the data should be pretty good, I would have thought.
Yep, it is. And there's always this comparison between Asian companies and US companies. that Asian companies being more family dominated, the management tends to sit on their hands and not unlock value. So which means when we buy a value stock, it could become a value trap for a long time. Do you agree with this kind of assessment?
To the extent that value has worked in developed markets, I mean, it's hard to say in any given situation whether it's going to impact or not, but value has worked. Value's worked in Singapore. Value's worked throughout Asia. I think if you're buying a portfolio of companies and you have 20 to 30 companies and you continue to monitor them over the course of a year, then you get a pretty good idea if management or the major shareholder is abusing their position, and that might be when you might want to screen out. That problem isn't unique to Asia, though. You find that problem in the US, you find that problem in Australia, where I started investing. You see that in Europe. You find that everywhere, and sometimes that's the broken leg. That's the reason that the stock is so cheap. And if you hold it, knowing that your shareholder rights are somewhat curtailed because there's a major shareholder there who might not respect the minorities as much as you might want them to. It's still, if it gets cheap enough, it might be worth holding on to, just for the reason that is the broken leg. And you can reassess it in 12 months or 2 years or 3 years.
Personally, I believe that it is a broken leg issue because I have invested in companies that are controlled by families, and yet they did very well over a 2-3 years period.
That's a strategy. That's a pretty well-known strategy. I think I've only seen it tested in the US, but you invest behind family-controlled companies because they do tend to have very good corporate governance, because they're watching the management, making sure they're doing the right thing because it's all of their money.
You have also co-authored the Concentrated Investing, whereby you talk about holding lesser stocks in a portfolio to boost investment returns. And in across multiple, it is also understandable that you should own 20 to 30 stocks. Correct me if I'm wrong. And while concentrated portfolio says otherwise, would you be able to marry this together, say an individual investor using across multiple but only hold very little stock, let's say 5 to 10 of them? What do you think about this?
The problem that you have when you get down to 5 stocks is it's enormously volatile. So your performance of any given stock is 20% of the performance of the portfolio. So if one of those companies goes to zero, you've torn up 20% of your capital. So that's the risk. I think in backtest, it does seem to work okay. The more concentrated you get, provided that your metric is a good one, and value tends to be a pretty good metric, you find that it leads to better performance, but it's also much more volatile. So if you go into a crash and the market's down 50%, you might be down 80%. But that's the price you pay for when the market goes up 30%, you go up 50%. So you get better performance doing that. But there's a lot of risk in it. It's not something that I would recommend for most investors. You need to be a pretty experienced investor and know what you're doing when you're doing that.
Let's say someone really want to run a concentrated portfolio using across multiple. How would he do it? Does he select the top 5, or he will look through the screen by having more qualitative analysis to fish out the 5?
You can do both ways. So in concentrated investing, we sort of talked about there are 2 ideas. So there's diversification. How diversified do you need to be in order to be protected from any individual stock getting too beaten up? And there's concentration, which is the way that you generate better returns. And the method that they talk about is the Kelly criterion as being a way of sizing up a bet. So the idea is basically the Kelly criterion, as it's defined, is edge over odds. So edge is your idea about what the thing is going to do that the market doesn't know, and the odds are sort of what the market valuation is offering you. So there is a way that you can turn a valuation and a market price into an edge over odds type analysis, and that would indicate how much of your portfolio you might want to put into an individual stock. So the one wrinkle to that is that when you go to sort of do these analyses, you have to understand that there's always a risk that there's a black swan that you don't know that it's out there that could send the company to zero. That's why it's cheap. and there are other things that you could possibly be invested in. You can invest in bonds, you can invest in sovereign bonds, you can invest in commodities, and that would necessarily size down your position. So that all of that analysis, I think, sort of tends to indicate that you should probably be doing it on a qualitative basis. You should be going in and finding other things that would be able to sharpen up your analysis of whether this thing is good value and can survive or not. But you've always got to bear in mind when you're doing that you might be finding broken legs as reasons for not doing things. I think 5 is a pretty concentrated portfolio. You're going to see some volatility with a 5-stock portfolio.
Definitely. Interestingly, Joel Greenblatt has also talked about the magic formula implementation, and a lot of people who try to cherry pick from the list did worse. In fact, they did worse than the index.
Right.
Which means for a diversified portfolio, one would do better by just blindly following the screen results.
If you're going to do that, then you want to buy the 5 cheapest. But I think that you have to be careful at that level of concentration, because, as I said before, you can lose a lot of money, and there's a lot of volatility in it. It's a portfolio that won't track the market. You're better off at sort of 20 to 30 positions. 20 is very concentrated. You get lots of performance out of 20. And 30, that means if any one of them goes to zero, you've lost 3.3% of your capital.
You have probably heard a lot of advice given in the investment field. What is one of the worst advice that you have heard?
Oh, it's advices that people shouldn't follow. There's a lot of bad advice out there. It's not hard to find bad advice. I mean, the bad advice is always it's all the received wisdom about the stock market. Bad advice is efficient market hypothesis. That's bad advice, and that makes you think in the wrong way. But the funny thing is that if you don't want to spend a lot of time in thinking about your investments, it's probably not a bad way to go. What the bad advice, the efficient market hypothesis is a bad philosophical background for actually a pretty good idea, like just buying the market index. But if you buy the market index at times like this and you look at the index, it's filled up with very expensive, probably overvalued stocks. That's what the index does. It's market capitalization weighted. So the more expensive a stock is, the bigger a proportion of the portfolio it takes up. So if you're buying the market index now, I think that the risk reward isn't very good at all. But that's the predominant advice that people are given by the market index. The argument against that is always, if value has underperformed for a long time, it's looked like a smart bet to be in the market index for a long time. And it's looked dumb to be a value investor for 7 years, 8 years, which is a very long period of time to underperform. So I think it's bad advice to just blindly buy the index, but that's the advice that's out there. I think you're better off finding value, doing the value investing yourself, or finding managers who have a good process that's clearly articulated, and then they adhere to that process, finding them at a reasonable fee, and then investing behind those guys, knowing that you can underperform for long periods of time.
It is the period of underperformance that make investors anxious and probably has less conviction about the investment strategy that they're following. So, which makes index investing a lot easier, and probably that's why the idea predominate.
Right.
You run a fund yourself, Carbon Beach Asset Management. Could you tell us a little bit more about this fund and what kind of investment style do you use?
We have two. We have basically what I've just described to you, sort of deep value, long short. So it buys long the cheap stuff, it's short stuff that is financially distressed and might have some fraud in it, earnings manipulation, ugly balance sheet, deteriorating financials. Like, that's the sort of stuff you want to be short. So you don't necessarily want to be short stuff that's expensive, because stuff that is expensive can get more expensive. So we don't short. The short book is not the opposite of the long book. The long book is just undervalued, cash generative, that sort of stuff. And it hedges as well. So if the market looks like it's falling, the market goes into a downtrend, it would hedge in an effort to sort of generate returns that don't match the market. And so that's one strategy that we run. The other strategy that we run is what we call, or what is known as special situations. So special situation is something that sort of turns on a corporate act. So there's a board level decision made to sell an asset or buy an asset, buy back stock, pay a special dividend, return capital, liquidate, buy another company. And when those decisions are made, sometimes there's a difference between where the stock is trading in the stock market and where there's an implied valuation when the event closes. So we look for all of those different types of trades. And the attraction to that is that it's investments that you find on the stock market, but it's not really subject to what the stock market does, because most of them are long short. If you see a company getting taken over, this is merger arbitrage. A company's getting taken over and the bid might be at $10 and the stock might be trading at $9.75. This is traditional merger arbitrage, and so you might buy the company that's being taken over and sell short the company that's doing the acquisition, and then you're trying to get that arbitrage of 25 cents between the two. We don't do that traditional merger arbitrage. We wait until the deal gets into trouble. And so the takeover bid's at $10, the stock's trading at $6. There's some risk that the transaction doesn't go through, or it looks like the transaction's not going to go through. But we think that the company that's being acquired is very cheap. And so then we would look at our downside as being, if the company doesn't get acquired, we've already bought this cheap stock. If it does get acquired, which we might put it, maybe there's a 1 in 5 chance that it actually does go through this transaction, then that you just factor that into the analysis. So there's a chance that you get a very good return. There's a 1 in 5 chance you get a very good return. There's a 4 in 5 chance that you end up holding a very undervalued stock that should be worth more down the line anyway. So that's the sort of stuff we're doing. And we'll look at a position and sort of make a decision whether do we want to own the equity? Do we want to own a leap? Do we want to own a long-term call option in the stock? Do we want to sell a put to get into the stock? So we'll look at the risk reward of each security that might be involved in it, and then we try to invest on the way that gives us the best expression of the risk reward for the situation. So that's special situation investing.
I believe that special situation will require a lot of active management. How about the long short side strategy? Is it active or is it more quantitative in nature?
It's what might be called quantamental. So we use, I personally hate that term, but that's sort of what it is, which is sort of a blend between quantitative and fundamental. I just don't trust the data, so I always want to dig in and just make sure that the data is correct. So we go through that process and we look for other things that you just can't screen for now, because the natural language recognition isn't as good as it probably will be in the future. If it gets to that point in the future, we'll be wholly quantitative. But at the moment, we go through and read. So I was an M&A lawyer, mergers and acquisitions lawyer for almost a decade. And so I go through, look at those documents and try to find things that might affect the valuation. Once we decide on the valuation, then we'll basically, it's quantitative from that point on. That we buy and sell where we think, this is on the long side, we buy and sell based on that valuation that we calculated previously. So that it looks to the outside world like it's a very traditional sort of looking value portfolio, but it's just we're systematic as much as we possibly can be, and where we can't be, we're very aware of all of the issues that you can have by avoiding particular stocks for certain reasons.
So in other words, you will use the Equurus multiple as a first screen, and you'll run through the list to see what stocks are probably worth investing in.
Well, we're not doing a business analysis at all. So we're not looking at, will this business survive, because that's just sort of an analysis that I can't do. I don't think very many people can do it at all. I mean, I'm a lawyer. I'm not a consultant or an investment banker. They might have a better idea about that sort of stuff. But what we're doing is we're looking at, are the economic earnings of this company, are they what the financial statements are reflecting? And if they are, then that's great, and we just proceed on the way we're planning to. If they're not, we want to know why there's a big discrepancy between what the company is showing on its financial statements and what's actually going on in the business of the company. Sometimes that indicates that there's some fraud or some earnings manipulation, and that's a company that we would avoid. Sometimes it's a timing issue because of the way that the business, it's a funny business. It might be an insurance business that has difficulty matching assets and liabilities. It might be a bank that has a different style of that have a different kind of balance sheet to just a traditional industrial. So that's the sort of stuff that we're doing. We're not kicking it out because we don't like the business. We're just trying to we're thinking about the nature of the business and how it's reflected in the financial statements.
So essentially it's about detecting fraud rather than business analysis, which might end up in a broken leg analysis, which we have just discussed.
Right. Exactly right.
So thank you, Tobias. It was a wonderful interview. I believe the audience have learned a lot from you, and it has been an honor to have you on the show.
Thanks very much for having me, Alvin. If anybody wants to get in touch, I'm on Twitter at greenbacked.com. Greenbacked, it's a funny spelling. It's Greenbackd. And the book that I have out right now is The Acquirer's Multiple, which is available on Amazon and wherever else you buy books. And the website is acquirersmultiple.com. It has a free screener, which has got the cheapest 30 of the top 1,000 stocks in the US at any given time.